So stocks, of course, aim to finish the year strong following the recent volatility. My next guest remained confident the market has more room to run. Let's go to Jay Hatfield, founder, CEO, and portfolio manager at Infrastructure Capital Advisors. Thanks for joining us today.
Happy holidays, Marilla.
Thanks. Same
Thanks
to
for having me
you.
on.
You're bullish on stock for the next year. What feeds into your theory?
Well, the most critical factor actually occurred last week when we got the CPI data. We're optimistic on inflation, and were before that report, because the shelter component is finally, in the US, we have the worst calculation of shelter inflation in the world. So we're leading the world in bad calculating, in that our measure is 2 years lagged. But in the last report, it got way closer to what market rates are. Market rates are pretty close to zero for rents in the US. And we were at 0.1 for 2 months, so it's 1.2. So as market collapses to, or as really the historical poorly measured collapses to actual, we'll get inflation down to 2, the Fed will cut 3 times, rates will go below 4, 10-year will go below 4, and that's supportive of a 23 times multiple, which is admittedly a full multiple, but not above historical averages when you correct for corporate taxes. So our target this year was 23 times next year's earnings, and then our, so it's 7,000 targets. We have a little bit of upside from here. And then next year, we're at 8,000, which is 23 times S&P earnings for 27.
Okay.
So we think those are reasonable targets, supported by strong earnings growth, likely acceleration in the U.S. economy as rates come down and the housing market recovers.
Okay, so you're building in here a corporate tax cut. What about without one?
Well, what I meant by that was it's perfectly reasonable to say, oh, well, 23 times, that's patently ridiculous, because the 20-year average is 18 times. But what people miss is that the corporate tax reduction in the U.S. was profound, in that we went from 35 to 21. So it's just like if your real estate taxes were eliminated and it's only your house and not everybody else's, then the valuation of your house would go way up. So we estimate that increased the sustainable multiple on the S&P by 4 points. So 23 is only 1 point above the corrected average.
Okay, let's get to sectors that you favor for 2026. We saw the AI run, of course, this year. We saw the metals run this year. What are you looking at next year?
Well, we would, because we're bullish on both rates and on the market as a whole, we would be risk on. So that includes in fixed income, should be in high yield and preferreds. We have 2 funds, BNDS and PFFA, in those sectors. But we think they'll beat investment grade substantially if we're correct about the market being strong. And then with regard to sectors, pretty much the same ones we had recommended this year. So financials, industrials, still tech, although we think tech won't really beat its risk-adjusted returns, and also consumer cyclical. So more risk on, just like what really worked pretty well this year, although tech was the leader among those. We think the other 3 will do better. So be out the risk curve. We don't think there's any chance of recession, and we're projecting 3% growth in the U.S.
Okay, so let's go through a few specific picks. In financials, there are a couple you like. Goldman Sachs is one, Morgan Stanley's another.
Absolutely. So we do think, although they're not as cheap as they were when we recommended them 2 years ago, the ongoing investment banking boom will support those stocks. And specifically, you've even seen that this morning, there was a couple of LBOs, been some gigantic IPOs. But we also do like some of the private equity firms like Apollo and KKR, because they benefit from the IPOs. And they also became discounted because we think investors massively overreacted to a couple of bankruptcies that we think were one-off and not really cockroaches.
Okay, so let's get to Broadcom, which you like. Tell me what you foresee for Broadcom.
Well, we do think that there's substantial upside that was actually recently created. So our target is about 420 where it peaked out, but it really went on sale for no particular reason. It reported pretty strong earnings. So we do see substantial upside now into that area. So we had been selling it when it got to our target, and then we've been buying it as it got down to the 330 area. So, targets are not just for promoting stocks, is also you're supposed to sell them when they get close to the targets.
Okay. So I do want to get to your next pick, which is Amazon in the tech space. With the Magnificent Seven, are you sort of spread out at anything else, or is Amazon sort of your focus?
Well, we think the others are pretty fully valued. We do like Marvell, which is like a Broadcom competitor, but on in the Mag 8. We call it 8 because we include Broadcom. But Amazon's pretty interesting in that it hasn't really participated in this tech rally. And it's more consumer cyclical, which should do well this year as there's rotation away from just the Mag 8. And what's unique about Amazon is they have a gigantic amount of sales, but not earnings on the retail side. And they're 100% focused on making that profitable. They're going to benefit from robotics. They've moved inventory closer to customers, which if you're a customer, you'll quickly realize because you get it a lot faster, but it's also cheaper. They're doing advertising. So we think that cost-cutting strategy has been underappreciated, partly because it is about half consumer cyclical. So we think it's going to do better relatively even to the Mag 8 next year than it has this year. It's really lagged. We do have a 300 targets. We see substantial upside.
Okay, I've got to leave it there. Jay, appreciate you joining us today. Jay Hatfield, founder, CEO, portfolio manager, infrastructure capital advisors. Coming